So let's first start with how you classify your rallies in terms of, is it successful or not?
Okay, so I took all the rallies back to like 1949 and looked at from the date that they have the follow through day till the date the rally is ending. What is the gain from the close of the follow through day to the close at the end date? I also tracked what it did at the peak because I wanted to know, like, what happened in between from the peak until the rally actually ends, and put them on a XY axis, got a scatter diagram, and started to draw lines like, well, how can we classify these? And I came up with these classifications that anything that lasted 15 days or less, and I'm talking trading days. This whole chart is trading days, not calendar days. Anything that's 15 trading days or less, it doesn't matter how much it gained or lost from the follow through day to the end date. That's a whipsaw because you really can't do very much in a very short period like that. Then I found many rallies that went longer than 15 days, but by the time they ended, they gained 3% or less from the follow-through day close until the end of the rally. And I call those small losses or gains or slogs because it does feel like a slog when you're going through it.
Exactly.
Okay? And anything that went...
because it fits so perfectly. Is that what a slog means? I mean, like it just that acronym fits so perfectly. Well done, Eric.
Well, thank you. I don't know if that does exist, but that's what I came up with anyway.
Yeah.
The easy ones were the life changes where they went longer than 15 days, and I picked a number that it has to be greater than 15%. So if you ever want to remember that one, it's 15-15. It's got to be greater than 15 days and greater than 15%. And then you kind of have this in between one where it's longer than 15 days. You gain more than a slog, but less than a life changer. You go between 3% and 15%. And that's how I classified them. And like you said, it's somewhat arbitrary. I found in terms of the way the scatter plot worked, it seemed to fit really well. But you do have to pick something. You have to pick some parameter.
Right. Especially, I mean, we learned that especially with spreadsheets, right?
Right.
It's when you program something, it either it is or it isn't,
Right.
and a lot of times you're like, well, I want that to be, but then it means changing the rule and you don't know what you're going to break down, down the road.
Right.
So, one other thing here that I think is interesting about this is, again, it's nice to kind of have this classification and everything. But how quickly and how long it lasts. I guess one of the things that sticks out to me, I mean, 15 days, as a criteria, that's not very much, but I think it makes sense because you can kind of make money, if it is over 15 days. If it's less, it's tough. But if it's over 15 days, you can do something with that, right?
Yeah, that's kind of how I came up with the number of days, because I was in my mind thinking, how fast do I have to trade and how, what's possible. And one of the other things not shown here in this presentation is that what is the average number of days a rally lasts? And surprisingly, 80% of them are over in 50 days or less, 50 trading days or less.
Okay. Yeah. And to me, that also makes it even more important that you recognize you don't have to be trading aggressively the whole time, because it's just, that's not where the money making happens. You have to really be, I mean, just like we always use the baseball analogy, you got to wait for those pitches. And if you're swinging at everything, you're going to wear yourself out and you're not doing yourself any favors. But if you kind of wait for that pitch that, oh yeah, that's one I can really belt out of here. It makes a big difference. So, kind of moving forward here, we've got a percentage here. So what might be surprising to a lot of people is that, again, there's a lot of these whipsaws. There's a lot of these, slogs. And maybe it's not surprising. It's special when you get in those money-making periods. Yes, the overall market goes up over time, but it doesn't do it in a straight line, I think, as we've all learned if you've been at the market for a while.
Right. And part of why I wanted to come up with this classification was when I first read Bill's books, and it said that follow through days, there was an implied amount like of 75% of the time, it was like a good signal 75% of the time. And it felt like it was less than that for me in my trading. Because when I first started, and I was trading silly, hey, this is going to work 75% of the time. The odds are with me. Follow through day, I'm going all in like 2 days. Because who wouldn't take a bet that's going to be like 75% of the time? And then I got chopped up many times. Like I first started doing that in like 2002 to 2003. There were a lot of follow through days where you were quickly out.
Yeah.
And you can take a small loss or gain and turn into a big loss or gain if you're going with the big bet and going in 100%.
Right.
So when I did this study, I found two things. Well, one was it's about a 2/3, 1/3 bet here, not 75%, 25. The red is about 2/3 of the time. It comes up, if you add those together, it's about 68% of the time, and the green are about 32% of the time. If you look at the small loss or gain, and I did have a chance to discuss this one time with Chris Gessel years ago about trying to categorize these things. He said, well, Bill would say that if you have 15 days and you can get out with a small loss, that the signal worked. So if you add in the slogs with the other green, you get the 75.
There's your 75%.
75. So we're both right?
Yeah.
It turns out that you can use these percentages to help you make decisions on how much to invest in a follow-through day. Now that you know these numbers, it's like you shouldn't be plunging in with everything.
Right.
And then we'll show with a graph how you can decide maybe how to get more invested.
Yeah. And what I also think is important to recognize is when Bill came up with the original follow-through day concept, and again, this is something that we talk about in the big picture on investors.com and in the paper, and you can read about it in How to Make Money in Stocks. Pick your edition. Just go to the market section. But his focus was really on the extremes a lot. Those major market bottoms, and we really kind of tried to branch it out to minor pullbacks. Sometimes how do you know in a mid correction or a mid pullback? And that I think does get a little bit trickier and changes some of these numbers. But I agree with you that at the end of the day, you kind of get that number where it is close to 75% if you consider those slogs not getting hurt as a success, right? So yeah, you basically went through this slide already, and I think the conclusion is the smart part here, where good buy signal, but money management is the key. So talk a little bit about how you do that with the money management.
Well, for me, I always have my eye on a few stocks, and there's not too many times I'm completely out of the market. Like, for example, this most recent correction into December, and we had that open up the morning, and the Nasdaq's down 1,000 points. I still have some stocks, but the way I manage things are, I was backing off, and then we get that reversal, and I start to go in a little bit, and like trying to be like bending like the tree in the breeze. If it starts to work, I add more. If it continues to work, I add even more. And for me, on a regular follow-through day, let's just pick any random follow-through day. Let's say I'm not in the market at all. I will force myself. I will invest some money on the follow-through day. And depending on how the market's been in the shorter term, if it's really been like one failed follow-through day after another and the market's not looking good, I might start off with a half position of a stock, half of what I would normally do. And maybe another stock if it's breaking out, another half. And then as they start to go up, and I try to follow that. If it's up 2%, you add like 30% more. If it goes up another 2%, add your last 20% and get 100% invested on one position. I don't mean 100% of your portfolio. I mean 100% of a position size of one stock.
Right. Yeah.
And then you see how they're doing. And the better it's doing and the better the market's acting, the faster you can get in.
Yeah, absolutely. So now one of the things to understand, of course, is, and this is the tough part, how do you know when you've gotten the heart out of the watermelon? as
Right.
as Bill used to say, and so when you're looking at a rally, the peak is kind of that best case scenario, but of course, no one sells at the peak. I mean,
Right.
that's just not feasible. So let's go ahead and go back to your slides and talk a little bit about where these peak and how much you can expect to kind of lose off the top when it's finally apparent that the rally has ended.
And on average, you're going to lose on a life changer almost 6% from the peak to where on the index where the rally is considered closed. Now
Mm-hmm.
that's the index. You can have, like, if you want to look at how Nvidia and Google and Apple from their peaks this July until where the rally ended in early August, you're going to see it's a lot more than 6%. So it's one thing to talk about an index. It's another thing to talk about your stocks. You can get some pretty big drawdowns from the peak to the end of a rally. So, and we get sell signals. That's the good thing. If you look at some of the stocks that, that corrected a lot, they bursted through their 50-day moving average. That's
Mm-hmm.
one sell signal. There's other sell signal that happened on the other stocks. And so, you have to always watch your stocks. You have to watch the indices, and you can help cushion the blow when it goes from peak to rally end.
Yeah. So, and what I like about this too is it kind of shows that the whipsaws, I mean, at the peak, 1.3, it's like, wow, that's not much you can do with that.
Right.
And especially when you're down 4% by the end of the rally. So,
Right.
not as pleasant. Now we're going to go ahead and move forward here, because you also have kind of graph this out, and it's important to recognize that when you're graphing something out, it's using the averages, right?
Right.
And while this looks so smooth and so pretty and so easy,
Right.
when you got a life changer, there are these kind of wibbles and wobbles that, and as you said, the stocks are moving more. So talk to us about what this chart is.
Well, as you know, I classified all the rallies, and then
Mhm.
I looked at the first 25 trading days after the follow through day, and I took all their gains and losses day by day and averaged them together. So yes, averages does a nice smoothing thing, and you can see that I did not know what to expect when I did this graph. I thought, wouldn't it be nice if they separated out?
Yeah.
And lo and behold, they did.
Right.
Um, and on averages, you can see how you get a life changer on the top line there in green, a money maker in black, a slog there in that kind of orangish brown, and then the whipsaws at the bottom. Now, whipsaws have to be 15 days or less. That's why that line ends.
Yeah.
There's no reason to track after that because the rally's over.
Mm-hmm.
But the rest of them go out to 25 days, and you can see how it average rally goes. And it's a nice thing to know, so you have your expectations.
Mm-hmm.
It also is something, because we have this, we can plot an individual rally against the averages and kind of know where we're at. It's like looking a little bit at a map, like, where are we?